So last year, we did a 100 a day day trading challenge for a month, and the aim for that was $100 a day while risking $200. And now we were only able to trade that because we were using options, which allowed us to easily take on leverage to an appropriate amount. And one of the biggest questions we get is how do we use options to trade and whether or not we can make similar trades without using options. And the answer is...
Yes, we simply use options because we already understand it, which we must add is quite complicated. Looking at a stock chart can already seem daunting, but once you add in strike prices, expiration, Greeks, etc., etc., it can become even more complicated. Some of you guys are really good with pattern recognition, some even better than us, right? And when you spot certain patterns, all you want to do is execute on that trade without having to worry about strike prices and expiration, and you don't want to use $10,000 of capital to just make 100. So we want to talk about a less well understood alternatives from options, and that's CFDs, or contract for difference. It's one of the simplest ways to capitalize on market movements with leverage. But there are some drawbacks to them as well. So let's explore who and when should someone use CFDs or stick to options.
So what exactly are CFDs? CFD stands for contract for difference. Essentially, when you trade a CFD, you're entering into a contract with your broker to exchange the difference in the price of an asset between the time you open and when you close it. But here's the key part. You don't actually own the underlying asset at all. Instead, you're predicting whether the price will go up or down. The primary focus is on price movement rather than all the other variables. So one of the big advantages of CFDs is leverage, which allows you to control a larger position with a smaller amount of capital. Without leverage, my profit target is $100 a day. But my targeted move is only 0.2%. But with options, that capital requirement drops down to $5,000. And similarly, for a 1 to 10 leverage option, the capital requirement drops to $5,000 as well.
Let's compare the differences between setting up this trade with options and with CFDs. With options, on top of fees and spreads, you're balancing strike prices, expiration dates, and Greek. This enables you to design a very specific profit graph that suits your trading profile that day. If you are an advanced trader who is looking to take advantage of time decay and designing a non-linear profit graph, then this is for you. And if all that seems unfamiliar and complicated, then CFDs are probably better. With CFDs, the focus is simpler. You're primarily managing the movement of the trade and your risk to reward ratio. For example, with CFDs, there's no need to worry about options expiring worthless because there are no expirations. There's also no need to monitor the Greeks because CFDs are fixed. A CFD trader can focus purely on market direction. Let's now take a look at an example.
Alright, so Aaron from the future here going to share with you an example of how this would look like. So I'm going to share with you a potential trade, something that maybe we're all a bit familiar with, the trades that were happening around election day. Now I'm going to show you an example of how it would look like if I was using options, and then I'm going to show you how it's going to look like when I'm using CFDs. So let's start with options first. First, I'll need to find the option and decide on the expiration date. Am I going to be trading this for just 1 day, 2 days, or 3 days? Next, I'm going to have to decide whether I want to profit off theta decay. And once I'm done, then I can head over to build my spread. And after that, I can look at my profit graph to roughly get my risk to reward ratio and decide where I want to take profit and where I want to put a stop loss based on the options that I purchased. And after that, I head back to the charts, and over time, I plot an estimated curve of where my take profit would be and where my stop loss would be based on the market volatility, and observe the Greeks for any sudden changes, if earlier or later. And that's what really goes through my head as I'm trading options. Even if we can see a very simple channel forming, I want to trade the breakout. When the breakout happens, I still need to go through all that and decide on my risk to reward and all that. And sometimes I miss a good part of that, and sometimes I don't, which is why trading options, especially for trading for theta decay, it is not as simple as looking at the charts and simply entering the market, which is why I also want to talk about CFDs. Now, many of us are very well trained in technical analysis. We're very good at pattern recognition, and But if you had to go through all these steps, but if you're not very familiar with profit graph, even though it does help your P&L in the long run, if you're not familiar with it, you may make wrong decisions, right? Which is why I want to show you how simple it is with CFDs. And now let me show you an example of a trade when you're using CFDs, right? So just off the cuff right here, we can see there is a bear flag coming somewhere along here. And what we think is that maybe price is going to head up somewhere along here. It's going to bounce back down and maybe break through. And you want an early entry right here. Now let's just assume we are already there. Let's make a deal. We press sell. And we can set our stop loss just slightly above the previous set of resistance. And if it breaks down, we want our take profit to be beyond that. And that's it. That's how you set up a CFD. Just that simple. Stop loss, take profit, entry price. And the best part is the risk to reward ratio is already here. So if you're someone who is very good with technical analysis and you don't want to worry about theta decay and all of that, CFDs is probably one of the best options you can go for, especially if you are a day trader. But in our experience, we found CFDs to be much more straightforward to manage compared to options. It's especially true if you prefer focusing on price action rather than the complexity behind the trade. When I started trading, I used CFDs because it's easier to get in and out of trades without having to consider expirations or theta decay, which can really eat away at your profits with options if you're not aware of how they work. So if you're someone who's struggling with the complexities of options but still want to leverage your trades, CFDs could be the right fit for you. It simplifies the trading process without sacrificing the power of leverage. And now, IG, which is the sponsor of this video, is one of the best platforms you can try for CFD. We were using their platform to showcase the examples earlier, so if you're interested in it, go check them out. One of the best reasons to go with IG is that you do not have to worry about gapping or slippage, allowing you to truly define your risk to reward ratio. Now let's cover the pros and cons before deciding if you're ready to dive into the world of CFDs.
As much as they sound really awesome, CFDs also has its caveats. It can work well for both day traders and short-term swing traders thanks to its simplicity and fast execution. But since you're not buying the underlying stock, this is not good for long-term swing trading or buy and hold. Most CFDs have overnight fees for holding onto that contract, which does not make it the best option for long-term holding. And by not owning the asset, you do not benefit from the dividends either. For someone thinking about long-term trades, options may be better suited as you can profit from theta decay or time decay. So while CFDs are great for quick in and out trades, options may be good if you're in it for the long game. And if you're looking to get quick in and out trades, CFDs may be the right tool for you. Options might still have the upper hand if you're in it for the long game. And remember, it's not mutually exclusive. You can use both tools depending on your strategy. As with any financial instrument, there are risks involved. And one of the biggest risks is the potential for significant losses due to leverage. It's important to understand that while leverage can amplify your gains, it also amplifies your losses. So while CFDs are a lot simpler, you'll still need to understand how leverage impacts your trade. Always make sure to manage your risk properly and only trade what you can afford to lose. Like with options, CFDs require solid understanding of the market and the risks involved.
So to wrap things up, CFDs can offer a simpler alternative to options if you're looking for leverage, with your primary focus on price movement. They're straightforward and flexible and can be a great tool for both day traders and really short-term swing. If you are a long-term swing trader or a buy and hold kind of person, then buying the assets directly or using options would be a much better choice. So I hope you found this video helpful, and if you want to ask us any questions, feel free to drop them down in the comments below, join our Telegram group, and if you're interested in CFDs, you can always check out IG's platform.